Oh my God, you guys.
Look alive.
I'm furiously closing out tabs. I had way too much open, which would affect my resolution, and I want people to get the full effect. Hey, it's 5 o'clock on a Tuesday. We are here with an all-new edition of What Are Your Thoughts for those of you checking out the show for the first time. His name is Michael Batnick. My name is Josh Brown, and each week we gather together here with a few thousand of our loyal live pounders and talk about all the biggest developments in the markets and the economy, and we have an absolute blast doing it. So
Can I
thank
say
you guys
something?
for joining us.
His name is, my name is, that's a very 80s movie theme. That's like Weird Science. You know what I mean?
Is that bad though?
No, I love it. It's retro.
I thought it came off well.
Yeah, I love it.
Let's say hi to some of the viewers, and then we'll get to our sponsor. Teo Wa is here. Just Dave. Ronald Aramenta. Matt Stevick says Batnick button down. That's right. Very rare.
Ooh.
Almost
button
never.
down. I'm wearing a button down. You're right.
Akbar Muhammad likes the big pony polo shirt. Thank you. Vincent Aguilar is here. Rose is here. Hello.
Hello.
Lawrence Raponi. Two brothers say, "What's up? What's up?" All right. All the pounders are here tonight, and we love you guys for coming out for the live on YouTube. And as I like to say, the chat is already lit. Tonight's show is brought to you by Betterment Advisor Services.
Solutions.
Betterment Advisor Solutions. If you happen to be thinking there's got to be a better way to grow my RIA, you're not alone.
With Betterment Advisor Solutions, we do the heavy lifting so you can focus on what matters most to your clients, from improved service that makes asset transitions smoother
to fast paper-free onboarding that delights clients on day one. We've built a digital-first platform designed to stream your operations and make life easier.
Now, if you're thinking, wow, they take the paper out of paperwork, then you'd be right. Grow your RIA your way at Betterment Advisor Solutions.
Learn more at betterment.com/advisors. Investing involves risk. Performance not guaranteed. Okay. We have an action-packed show. There's all kinds of... who could it be? Look who's here. You guys, we are in the presence of absolute greatness. Neil Dutta has rung the doorbell. Yeah, literally.
Hi, guys.
Neil, thank you so much for stopping by. And perfect timing, because starting on Friday is another Jackson Hole August weekend. And this is the last one, we think, for Jay Powell. What do you think?
I think that's about the safest bet you can make. It's going to be his last.
Neil, are you a Jackson Hole truther? I don't even know what that means, but are you?
Well, I think that what is it? So what does that mean?
Like, does he believe that it exists?
I certainly believe that it exists. I think if I had to say what it would mean, it's like that you're going to get some big signal out of it, right? I mean, because this dates back to like the Bernanke era, right? When he basically greenlit QE2, if you remember, at Jackson Hole. And really ever since then, everyone's always kind of looked at Jackson Hole for some kind of signal. I mean, if you remember last year, Powell basically greenlit a September rate cut. We didn't really know whether it was going to be 25 or 50, but he greenlit a cut. He said the time to adjust policy was now. It kind of comes and it goes. I mean, there are times when there's not really much news that comes out of Jackson Hole, and there's times when there's lots of news that comes out of Jackson Hole. So, we'll see which one this will be.
Last year, the speech was 15 minutes long. Barron's has a piece. They're calling this year Powell's last stand. Like, this is his last chance to cement his legacy, is the way that they're taking it. Like, basically, he might end up using this as like a defense of the independence of the Fed. Might be like a whole thing about that. Who really knows? Last year, when he greenlit the rate cut, I don't think people thought, okay, we'll do one and done. But that's how it ended up being, because the economic data just, I guess in his eyes, didn't justify more. So even if he does signal that they're ready to cut rates in September, nobody should take that to mean anything beyond September.
Well, I mean, last year they went they greenlit the September cut, then they ended up doing 100 basis points worth of cuts for the year, right? They went 50 in September, and then they went 25 at each of the remaining 2 meetings.
Yeah.
It's interesting, looking at that Barron's article and what is his legacy? Because obviously they're framing it in a way of okay, he's this last line of defense against Trump and the Fed's independence, and inflation fighting and so forth, and leaning against tariffs. But let's not forget, before COVID, his legacy was supposed to be the guy that had this inclusive labor market. Remember that? I mean, basically bringing people in at the margins of the workforce and sort of, I guess I can say this as one, leave no minority unemployed kind of thing, right? I mean, so it was basically about running the labor markets hotter, and sort of, inflation expectations were anchored. And so the Fed had more room to kind of let the labor markets run hot. That's what his legacy was going to be before.
What do you think it is? What do you think his legacy is as the chapter is closed on, see you, Josh, as the chapter closes on Jerome Powell? What do you think the legacy is going to be?
I think if you give it enough time, I think his legacy will be one of, the Fed basically delivered reasonably good economic outcomes in pretty trying times. That'll be his legacy. I mean, and part of this was stuff that Governor Waller talked about before, which is, how do you get a soft landing? And, the Fed leaned into this idea that you could essentially trim job openings without seeing much of an increase in unemployment. And, by and large, that bet was a successful one. And if you look at, you have to grade on a curve, right? Could the Fed...
Dude, he was coaching the 2017 Warriors.
You have to grade on a curve. That's kind of what I believe. And so, if you grade on a curve, I think, the Fed did reasonably well over this period.
All right. So zooming in on where we are today, where do you think rates should be? And what do you think he's going to tell the world in a few days?
Well, I think that he's going to try to give us some meat around the bones of how they kind of think about both sides of their mandate, right? They have one of employment and they have inflation. And the tension right now is that, the labor markets are getting worse, but they think inflation might be getting worse too. And so how they resolve that tension is going to be very important. Now, Powell has a really tough job because this isn't like last year. Back then, everyone was on board for rate cuts, right? It was really just around the timing of when they would do it that year. It wasn't whether they would do it or not. That's not the case this year, right? Right now, it's like a bimodal distribution. You have a bunch of people that think they should cut twice, and you have a bunch of people that don't think they should cut at all. And so it's really his job to kind of find a middle ground. And that's why, Bloomberg has this article, wager for half-point rate reduction faces test of Powell remarks. I don't think he can make a strong signal like that at Jackson Hole. There's no way you can do that before the meeting because you have so many people that are out there telling you, and they're still out there squawking. I mean, you had a bunch of, regional Fed presidents and so forth coming out and talking about this. There's no way to front run that meeting and kind of lay down the, the pipe for a big upfront move. I mean,
tell me if this is a reasonable take. The Fed cannot control tariffs and input prices. The Fed cannot control the labor market, particularly entry-level jobs that are getting smoked. But what they can control and what they have absolutely wrecked a huge piece of the economy is the housing market. The housing market is all sorts of effed up. And for that alone, rates should be at least 50 basis points lower. Is that reasonable or is that ridiculous? Or somewhere in between?
Well, I think, I would argue that the Fed does have a little bit more. Over the long run, the Fed doesn't have control over the unemployment rate, obviously. But, I think there are times where if you provide some lift to the economy by lowering interest rates, you probably will generate some demand for labor.
Do you think they will today? Do you think that environment exists today?
Sure. I mean, if you like, for example, you just mentioned housing, right? I mean, I agree with you, by the way, on housing. I think housing is an absolute mess. And we saw more evidence of that today, right? I mean, you have, basically the main asset that's used as collateral in the banking system deflating in price for the last 5 months. That was out from Zillow this morning. And then, look at building permits today. Building permits hit another cycle low. I mean, builder sentiment was weak. So we had a raft of housing data this week that were all sort of not great. And so I would tend to agree that if you have a housing focused view, that it kind of makes it pretty obvious that you should be cutting. But at the same token, I mean, this is also probably one reason why builders are probably on the verge of cutting construction workers, right? I mean, they need to rationalize their building model relative to what they're selling. So that means cutting costs, which means cutting people.
Oh, who could it be?
You have no idea. You have no idea what just happened. There's like a
Power
there's
come
like
out?
there's like a Wi-Fi setup that just crashed off the wall onto the floor.
We're gonna blame that. We're gonna blame Hurricane Aaron.
Fed's got to cut. Josh, welcome back. But Neil, for people that are like, no, it's all good. For people that are looking around and saying the S&P is at an all-time high, Chamath is launching a SPAC. There is speculation in the streets and in the sheets. How could they cut rates? Isn't that such a red herring? Like, does that matter at all to the conversation? The inputs that
you don't need to take my word for it. You don't need to take my word. You have a very good analyst in your own shop that made that very precise that argument.
Shout
recently,
out to Callie.
So shout out, yeah, Callie made that argument, and I agree with her. I mean, look, I mean, you usually at the time of the rate cuts, the markets are not that far from their highs. That's also true, by the way, of like at the time, if you look historically, of like the first negative jobs number, the stock market's not too far from its highs. So I think what's important here is, like, if you're the Fed, do you care about financial market conditions, or do you care about financial conditions in the real economy? Like, if financial conditions are this loose, why is it so difficult to buy a home? You look at the Fed's own loan officer survey, lending standards for C&I loans, CRE loans, multifamily residential loans, they're all still tightening. Different parts of the consumer credit space are also tightening. So just because financial market conditions are loose doesn't necessarily mean that financial conditions in the real economy are as well.
All right, last thing for me. As we go into the week, there is I think a misunderstanding or misexpectation. I don't know what I'm looking for. People tend to think that Jackson Hole is a market moving event. And unfortunately it was in 2022 when we were at Future Proof. That was a lot of fun not. But Bespoke has this chart showing how the market has reacted during these weeks. And it's sort of nothing with nothing. I mean, maybe a little bit elevated, a few outliers, but overall,
Well, this goes back to the point that I made earlier, is that there are times when it's a huge signal for what's about to happen. And there are times when it's just sort of an academic discussion among friends about, things they're looking at in the future. And, this time it might be a little bit of both, right? I mean, the Fed's going to talk up their framework review, right? I remember back a few years ago, they had this flexible average inflation targeting thing that they put in place, and that lasted all of, about a few weeks because of COVID. But, so this is sort of, you're going to have a little bit on the near term, and I think a lot on, how the Fed is thinking about how they're going to deal with supply shocks in the future.
My only question is, why don't you get invited to Jackson Hole, or have you been and you've opted not to go? Because it would be much harder for you to analyze this if you became part of the show itself.
I think the primary reason why I'm not invited is because I don't have 3 letters after my name. PhD.
Is it as simple as that?
No, I mean, it's not. Look, I think some of the bank economists have in the past gotten invited, but really this is, it's central bankers talking amongst themselves. That's kind of what, and presenting their research, and that's largely what it's been about. I think the Chicago Fed or the Booth School at the University of Chicago does a nice monetary policy forum. I'd like to be invited to that one day. That'd be cool, but not expecting an invitation to Jackson Hole anytime soon.
Well, if you do get invited, yours will be the commentary I most look forward to.
Thanks,
coming out of that event. All right, Neil, thank you for bearing with us. I'm sorry I dipped out for most of that. I will be rewatching it later, technical difficulties, but awesome to see you and enjoy your end of summer vacation.
Thanks, Josh. Bye,
Thanks,
Michael.
Neil.
Take
All right.
care.
Later.
All
All right,
right.
we're back. You good?
Yeah, no, I'm great. You got to take us to the next topic. I'm attempting to get my Wi-Fi back up, but it's
All right. I
you would
got you. I
not
got you
believe the
back.
sound that this made
I got you
when
back.
it all came crashing down. Go
All
ahead.
right, we're talking. This is good timing because a couple of weeks ago, was it last week actually? You and I played the game, maybe two weeks ago. It was 2 weeks ago. Which falling stock would you most want to buy? And I believe
The falling knife game. We love
yeah,
that game.
I believe we landed on United Health. Maybe my memory's faulty, but either way, there was news last week because the 13Fs came out, and a lot of people bought this knife, Berkshire included. So they bought more than 5 million shares throughout the quarter. We don't have an average price. They spent one. Oh no, yeah, my bad. We do have an average price. I could back into it, but I didn't do that. So apologies. They bought 5 million shares for $1.6 billion. Chat, what did they buy it at? Help us out. It is chart on, please. It is their 18th largest holding. So they've got a $1.6 billion position out of, call it 200 and I don't know, the market's up since then, $280 billion portfolio.
Tiny,
Yeah.
tiny. But all right. So I think it's important to point out that a lot of times they will start out buying something and they're nowhere near finished. They might never buy it again. They might sell it next quarter. They might spend 2 years adding to it every time they report. Every time they file a 13F, they might add to it. So this is one of those things where it's like too early to really like assign a hard and fast decision on what they're doing here. But it is classic. It is classic Buffett. I don't know if this is one of his picks or one of the lieutenants. I would imagine they're involved in the conversation, the young guys, because he's retired as of the end of this year. But what $25 billion in earnings at a $250 billion market cap? Like this is like what they do. So
So I forgot to include, I didn't include this in the image because it was tough to see, but I clipped that from Slick Chart. So shout out to them. All right, I just did some math. I used this thing. Remember this? $320. That is the price, the average price that they were in at. United Health traded as low as 235. So, oh my God. They thought they were getting a bargain, and maybe they did, but they still had to sit through a nasty drawdown. And mind you, the price today, so they popped on the news, obviously. It wouldn't take much for this rubber band, which is stretched all the way down to pop a little bit. The stock is still at $304, so still a little bit underwater. But listen, United Health is not a company that Berkshire could buy. It's a gigantic company, and who knows what their intentions are. But they're not day trading this thing. They're not looking for a quick, 5-10% pop. That's not what Berkshire
I agree with
is.
that take. And I would also point out it's even more notable that David Tepper, Appaloosa, was also buying it at the same time. And I'm sorry, I don't know if there are historical examples of stocks where they got a Dow stock cut in half with both David Tepper and Warren Buffett buying it at the same time. But like I have to believe that's going to have a good outcome
You
for
would
the
think.
people that. Now, a lot of the people that I do TV with, they were long the stock already. And, they were excited because in many cases they owned the thing from 600. So they rode this thing down from 600 to 270. They averaged down the whole way down. They defended it. And now, like Buffett coming in the low 300s, I feel like it's a get out of jail free card
It's
for the,
validation.
it's validation that, like, see, there is value here.
Yeah.
Unfortunately, if you loved it at 600, it might be a minute before your investors care, but at least you save a little bit of face on TV,
Here,
having
here was some,
defended the stock.
here were some other moves. They took a small stake in steel manufacturer Nucor, Lamar Advertising, security firm Allegion. They got back into home builders. I think that's notable. You and I are in that corner. They bought Lennar and DR Horton, and they did some trimming in Bank of America and Apple.
He's got a long history of being in and out of the home building and the housing related stocks. Thought it was really interesting that Home Depot missed on the top line and the bottom line, and the stock traded higher.
Yeah,
That actually helped. That actually helped the Dow buck the bigger trend of down stocks. Home Depot is a $400 name, and I know you don't care about dollars, but the Dow does.
Yeah.
And that United Health last week and Home Depot this week, those are two kick save stocks with high dollar share prices that
Mm-hmm.
help the Dow 30.
Oh shit. Oh shit. Was that a misprint? My bad. I just got excited about a stock that was the fat finger trade, I suppose. All right. Anyway, Home Depot is a stock that I own, and I didn't read the report yet today, but obviously investors don't care about what happened last quarter
Nope.
because it's not relevant. All that they care about is what is the next Fed chairman and rates coming down, and that really is it. So, John, can we throw this chart up? I thought this is interesting. I couldn't find it. I saw Robert Armstrong at the FT did a post on Berkshire versus property and casualty companies, and I couldn't find it, so I recreated it. Here's the chart. People have talked about prior to, I guess, the last couple of years, over the last, remember there was a time not too long ago, over the last 1 year, 5 year, 10 year, 15, 20 years, Berkshire had underperformed the market.
Yes.
Not anymore. Not anymore. So the purple line is Berkshire. The blue line is the S&P. And the orange line is, I guess, what you would bucket them into, although I know they're not really a property and casualty company, but certainly they are a giant insurance company. And however you slice it, I mean, they've kicked ass. The stock has worked every which way.
Yeah. And what's so crazy about it is that the outperformance is persisting through this AI moment and the cloud computing era, and Apple obviously helped them a lot. But then, like, insurance business was great last year. Like, premiums were high, not a lot of underwriters were out in the market, and there weren't any massive catastrophes. There was the wildfire episode, but like that was a great year, for example, for all the P&C insurers, and that's a huge part of Berkshire's business. I know Geico was doing really well, and then the railroad was doing really well. So like there's just so many different ways to make money as a Berkshire shareholder. The exposure to financials that they've largely taken off by now, but they had on. So it's like I don't know. I shudder to refer to any individual company stock as an all season kind of stock, but if ever there were one, I really feel like it's Berkshire. Even when people are disappointed with it, all that usually means is that it went up slower than
Yeah.
some other index, you know? So
All right.
it's definitely having another moment again this year, though. I agree.
Last thing before we move on to Josh's topic, if he comes back, Josh, come back,
Yeah, I'm
is
here.
Michael Burry. Credit to him. This guy's a sense of humor. So his 13F came out, and who knows what positions he still has on, but he famously got mocked and ridiculed on this show as well as others for just tweeting sell, which is a fairly irresponsible thing to do, especially when it doesn't work. If it worked, yeah, hindsight is 2020. We probably would have spoken differently. But we did flag it.
He'd be on the cover of like
Yeah, no,
everything.
but anyway, the guy's got a sense of humor. He tweeted "buy!" exclamation point with all the activity that he did, and whatever. Credit to him. He was getting in there, and he's got some positions that he probably made a lot of money on. Although those Lulu calls, that doesn't look like that aged well. But but whatever. He's laughing at himself. So appreciate that.
All right. So I can't
I
see
gotcha.
what I wanted to discuss next. So just tell me what it
gotcha.
is. Prompt.
All
Give
right,
me a little
chart on.
prompt.
Chart on. So we're talking that there are now
Oh, this is
30
so good.
AI ETFs. Our friend Todd Sohn did some work here. So, Josh, can you see what we're looking at? If not, I'll talk through it and then you could comment.
Yeah, no, I can, and I love
Okay.
this because it's such a reminder. It's such a powerful reminder that sometimes you can have a theme that's so popular that everyone knows it's going to work, and like the knee-jerk contrarian in people is to be like, sell it. But like then it just keeps on working. And for me, that's the story of 23, 24, and now the first 8 months of 25.
Yep.
AI has been the obvious growth theme for the entirety of the last 2.5 years, to the point where there are 20 different pure play ETFs. They're all raising money. And they're all buying the same stocks. And then also in Todd's work, there's another 10 ETFs that are like AI infrastructure, where they're buying the utilities and the natural gas transmission companies, and it's like obvious to everyone, and also still a great investment. Not everything has to be mysterious, I think, is my point. Not everything has to be like, oh, this is so popular, I'm going to go the other way. It's really important to fight that instinct, because the herd's not always wrong. They're wrong at the end. They're wrong at the beginning. In the middle, the herd is the herd because whatever they're doing is working. What are your thoughts?
So it's funny. Ben and I spoke about that exactly today, about people wanting to make money the hard way by being contrarian. But yeah, you're right. And I would argue that the obvious trade, and again, hindsight, but even still, was the FANG stocks. That acronym, I think, was born in 2017. And
Yeah.
there's been people that have been fighting this for going on 8 years. By the way, I didn't even know that IFRA was a thing. John, throw that chart up, please. So IFRA is the iShares infrastructure, U.S. infrastructure ETF. And flows are coming in, not surprisingly at all. And let me tell you, I'm looking at the top 10 holdings, and it's 1, 2, 3, 4. Sorry for counting on air. There's 4 industrials and 6 utilities. The largest stocks are CSX, Norfolk Southern, Primoris, which is not a stock that I know, Evergy. In fact, you know what? I don't know any of these names, if I'm being honest.
Yeah.
Hawaiian Electric, Bowman Consulting.
So, Sean and chart off for a second. So Sean and I did a write up I think it was last week or the week before. First of all, our best stocks in the market list is loaded with utilities, and we're trying to write about them individually because nobody knows anything about any of these companies. And one of the most interesting ones we wrote about was Dominion, which is in Virginia, and it's like we talk. I think we did this as make the case, maybe last week, but like you're talking about a company where all the data centers are within their domain, and like you talk about an AI play, all the software, all the chips, all the GPUs, all the data centers are worthless if you don't have electricity coursing through that. And the fact that all those data centers are located in Loudoun County, Virginia, of all places, and this just happens to be the regulated utility that's sitting there electrifying everything. It's just, and that's obviously a utility stock, but like it looks incredible technically. It does nothing but go up because the estimates keep going up. There are so many stories like that we don't associate with technology, but the charts are just lower left to upper right and continue to work. So why is that happening? Well, you've got 20 different ETFs that are allocated to these stocks, and people are buying these ETFs every single day. And they won't stop until they get some sort of a signal to tell them to stop.
So this iShares U.S. infrastructure ETF that I've never heard of, ticker is IFRA. The thing has $3 billion in assets. And needless to say, it didn't exist 3 years ago. Okay. Like it was just 0 to 3 billion in a couple years. Impressive. Josh, you had Sean make a chart on VGT, which is the Vanguard Information Technology Index Fund. I'm curious, why do you care about this one? Chart on, please.
According to Todd, this is the first sector ETF ever to break $100 billion in AUM.
Oh, wow. The Vanguard one. Huh.
How do you like that?
More than
Not
XLK?
No,
Wow.
no. And I think it's a model portfolio story.
Oh, yeah. Well,
Look,
it's got to be. Yeah, there's no other explanation. But still.
This is what I think. I think financial advisors are trying to please their clients, and they're using this as an overweight mechanism to just give them more exposure to the most obvious trade on earth that's been the most obvious trade on earth for the last 2 years. As we talked about, this is such an easy way to do it. It's like, oh, just slap in 10% VGT. It's low cost, it's an index, it's Vanguard, so no one's going to yell at you. They're not going to fuck it up. And you'll end up with exposure to these tech stocks that just, they will not relent. Like they go down for 2 weeks and then they go up even more when they recover. Like look at semiconductor stocks. They crushed these stocks this spring. and then they're up like 30% from where they started. So I think people are using VGT as that kind of like, let me shut my client the fuck up overlay, and it works. It's doing the job. Now you're an advisor. Look, I talked to Terranova about this. Joe Terranova's got a momentum and quality fund, so he's screening for quality and he's screening for momentum, and he's got whatever it is, 40 names, 50 names. He had advisors tell him, like guys at UBS, guys at Merrill Lynch. He knows these guys forever. He's been traveling around the country talking to advisors. And they tell him, like, Joe, I don't know these stocks. So I use your ETF so that when my clients call up and they're like, why don't I own Palantir? Oh, you do. Here, you own it in the Joe T. So it's interesting. Like, this is like a thing that advisors and portfolio managers are struggling with. And I think the VGT breaking 100 billion tells you all you need to know. That's advisors shutting their clients up. Here,
Yeah.
you happy? Here's your tech overweight. I gave it to you. Okay? Can we can we talk about funding your grat now, or whatever you're working on with the client? So we have more from Todd here, or that's it?
There
What
was
else do we have?
one. There was one chart that we skipped over. I mean, we discussed it. The AI focused ETF inflows going vertical. Listen.
The bottom pane is the inflows.
I hate to short term. Who gives a shit? But it certainly feels like we might be at a pause. It went. Everything went parabolic. Everything went vertical. The
I agree, it's
headlines.
stupid.
It's stupid. We're in silly territory.
Did you see that Palantir just erased its entire post earnings gain?
I
Someone
did
just
see
shared
that.
with us.
I shared
That's a
that.
wild. That's a wild chart. That's an
So
Empire State Building chart.
yeah, and Carp and our boy Dan, they were talking a lot of shit on the call. The stock gapped the hell up higher, shut every bear up, went up for a few more days, and then whoosh. I mean, listen, the bulls have had the last laugh, or they're enjoying themselves. Who cares? It's down 60%. It's up a gazillion percent. But yeah, we'll see. All right.
16. It's down 16% from the high.
Yeah, whatever. So
Whatever, right?
Yeah,
They
whatever.
can announce one contract with like Russia tomorrow, or like
Yeah.
who the hell knows what they could announce, and
Yeah,
you can get that all back.
before bears start getting salty and start flexing, it was at 66 at the April low and it went to 190. It's now 155. So we'll see. All right. Last week and every week we talk about these gigantic tech stocks that are not even tech stocks. They're everything stocks. Amazon being a classic example of what even is it? How do you describe it? It does so many different things. And like a gigantic ocean liner, it's just demolishing anybody in its wake. And this week was Instacart. Now, the shares have since recovered a little bit. But what am I talking about? Here's what I'm talking about. This is from Bloomberg. Amazon.com plans to offer same-day grocery delivery in 2,300 cities by the end of the year, more than doubling the current number and making it its latest attempt to muscle into the $1 trillion grocery industry led by, of course, Walmart. This is the face blower to me. So U.S. shoppers spend $1 trillion annually on groceries, and yet online grocery sales represent less than 20% of that. Now, it's a gigantic number, and there is a natural cap at some point. Like, people want to go to the grocery store. Not everybody has Prime, et cetera. But still, there's room there.
Yeah, and it's not even just that there's room there. It like forces Target and Walmart to play defense, because those stores have very, very successfully used grocery to drive foot traffic, for people to buy other things while they're there getting their groceries. And it's been an amazing strategy. But if Amazon starts picking off grocery customers, well, those are less trips to the store, to the physical store. I don't know that Amazon's e-commerce lead is terribly powerful versus Walmart anymore. I think a lot of people just interchangeably will order things from Walmart's e-commerce operation at this point. But Amazon going same day with things like produce and meat and eggs and the kinds of things people don't want to order and wait a day for, the kinds of things like people like, no, I want to make this for dinner tonight. Or no, I get the eggs now or I have to go to the 7-Eleven. I have to go to like a convenience store or a supermarket. Oh, don't worry about it. Amazon will have them here by 5 o'clock. To me, that's behavior changing. And it's a really big deal. And the Maple Bear thing with Instacart. At first, it's the worst service ever. Have you ever used it? You ever
No.
used Instacart? So I had to on a couple of occasions. I had to like order some stuff because I was coming back from Florida and we just had nothing in our fridge, and we were gonna land, and it was gonna be all the stores would be closed or would be too tired. So order groceries so that I get off the plane, I get home, and there are plastic bags sitting in front of my door waiting for me. I do like that, but like half the items that are listed in the app that they say the store has, they don't have it, or they have a different flavor, or the wrong size. So then you have to have this back and forth with the driver. Either you have a setting where you say to the driver, pick the closest thing available,
Mhm.
or the driver has to notify you. So like, oh, you wanted lemon Italian ices, they only have chocolate. So now you're having like this back and forth
That's
on
annoying.
the app, which sucks. And then they screw it up anyway. And then by the time the fees are taken out and you're adding a reasonable tip, because like you almost feel guilty not tipping someone who just walked through a store for you, it's just so egregiously expensive. Half the items are wrong. The website had it wrong, and it's a horrendous experience. So I'm not surprised to see an over the top reaction, negative reaction for Instacart if Amazon's going to come into this business. Not that they'll do it perfectly, but they definitely can't do it worse.
Here's another area that Amazon disrupted. I mean, not Amazon per se, but just everyone. Is there a worse? Is there a larger melting ice cube than the linear cable services?
No.
So, for example, we got news this week that YouTube is now throwing their hat in the ring to get the rights to show the Academy Awards. Last night, or 2 nights ago, I rented. It's not Blockbuster or Netflix. I rented Jurassic World
Oh,
Rebirth.
the new one?
Yeah. So anyway, I got it on Prime. Now I'm like, we're buying stuff on Prime. I mean, it's everything. It is everything.
Yeah.
I'm sure you could think things that they don't do, but it does everything.
Well, just look at how the cable companies and the media conglomerates are treating their linear TV assets. They can't shed them fast enough. Um, so NBC,
I'm,
Comcast, which is NBC, is getting rid of all the news channels. They're going to bundle it into Versant, which will include CNBC. MSNBC just announced a name
yeah.
change.
What's the name?
That's beyond bizarre, but no comment from me.
Yeah.
MS Now,
Yeah.
but then the NLW stands for News Opinion World,
Mm,
which
right.
I
Okay.
I'll bet you $1,000 that'll change between now
Yeah.
and the end of the year.
Okay. I will
I don't
not
think
take
that's
that
gonna
bet.
stick.
I will not take a bet. All right. Speaking of sign of the times and the feelings of or the not feelings to risk. Who cares about risk? The bullish IPO. Let's talk about that.
Well, my take was this is I don't have all the data in front of me, but I would just say it's billions of dollars in market cap for a company that is based in the Cayman Islands,
Mm,
which already it's 3 red flags. Not a fan. They filed an F1, not an S1, in order to go public. So an F1 is what you file when you intend to be a foreign domiciled company, but you want a listing on a U.S. exchange. So in this case, it's the New York Stock Exchange.
Josh, you want me to read some
Um,
of these things that you put in here?
yeah, give us some of the
Okay.
numbers.
All right. So, according to the F1, for the period ending in March 31st, 2025, it generated $46.8 million in total revenue, a 22% increase over the prior year. However, it incurred a pre-tax loss of $348 million. Earlier in March 2022, they reported annualized monthly revenue of $97 million. Analysts have noted that Bullish's business relies heavily on trading fees. Okay, obviously. All right, whatever. Here are the details on the IPO. They raised $1.1 billion via the sale of 30 million shares at an IPO price of $37 per share. Initial valuation, $5.4 billion. Wow. Shares open trading around 90, peaked near 118 before closing around 68.
Where did it close
So
today?
what's the
Did it follow
ticker?
through to the downside?
What's the ticker? It's
It's
BLSH.
the
Okay. Oh wow.
BLSH.
Yeah, that's not good. That's not good. It closed at $58 or $59.
Yeah. So this game is not for me. I think they're losing like 40 million a quarter or something. Or something. Like basically one of the problems here is that the value of their crypto assets rises and falls. And there's like an accounting treatment of that can make it seem like it's got like this erratic business, which I don't really think is the case. But it's kind of like a mediocre brokerage. They're pitching this story where they're better for institutional clients than Gemini or Coinbase are. I
Yeah,
highly
sure.
doubt it. I don't believe it. The one thing that I think generated that $100 open though is Peter Thiel's involvement. So I don't think he's like got a day to day here. He's an investor. He's an investor in a lot of things, but there's a Peter Thiel connection, and there was with Palantir, and people just like they name associate, and so it's like, oh, this is Peter Thiel's brokerage.
Yeah. Let me give you an alley-oop, Josh. All right. Today, quote, this is a quote from somebody, and you know who it is, Josh. Today, a company called Bullish came public. The deal was more than 20 times oversubscribed, and the stock opened up for trading 143% from its offering price. Wow. The underwriters actually did their best to tamp enthusiasm. The deal was supposed to be 20.3 million shares, priced between 20 to 31, but it was indeed upsized to 30 million, then priced 32, 33. I would have taken that a little bit higher, but you know what I mean. Arguably, they could have upsized it much more and made the price much higher. Josh, who was that quote from?
That's Jim Cramer, and the irony is the stock that Bullish reminds me most of. All right, so I want to say this: Bullish owns CoinDesk. So CoinDesk is one of the biggest media publishers in the crypto space, and Bullish owns it. I guess they bought it during the tumult of 2022. Okay, CoinDesk is great; they do a great job. I like those guys. But it's a media company attached to a brokerage service. So the irony of Kramer commenting on it, this reminds me a lot of the Street.com. And I was there for the Street.com IPO. I was in the business. And it came public in May of 1999, not right at the top, but like 8 months before the top. And this is no fault of Kramer's or anyone else's. This was just the level of enthusiasm for anything related to trading. The Street.com, along with MarketWatch, were like the two first websites that were dedicated to covering the .com boom in the stock market. And the Street.com was great. I was a subscriber. I almost bought the IPO. I'm glad I didn't. That They upsized that deal several times due to demand. I think it ended up at 73 on the first day, and then spent the next 25 years going to zero. Like literally, never had another bull market in that stock ever again. It was just this 25-year odyssey, falling from $73 a share, where it never belonged in the first place, to effectively zero. And then I think the assets ended up just getting handed to somebody else. But that's what this reminds me of. And I'm not saying the businesses are identical. I'm just saying thematically, we're now bringing CoinDesk public effectively, and we're saying it's a better brokerage than I don't know, Kraken, Binance, Coinbase, Gemini. How many other Robinhood? Like, come on,
Yeah.
what is this, like the tenth largest brokerage firm in crypto, attached to the Street.com of the crypto era, and this thing is worth billions of dollars?
Yeah.
Is that what we're doing here? Is that
Yeah.
is that where we're going with this? So that was my impression. I'm not surprised that it was a big IPO day. I'm also not surprised that the stock is getting crowbarred.
Okay. Here's what else is happening in the market in case you needed, lest you forget where we are in the temperature check. Social Capital's Chamath Palihapitiya is launching a new SPAC, raising $250 million for the American Exceptionalism Acquisition Corp. And Q Capital 2020 shared the filing and highlighted this part for us to take a look at. Here's a quote. We believe that retail investors should only participate if A, this investment is a small part of an otherwise diversified portfolio, B, this investment is a quantum of capital, who says quantum, they can afford to completely lose, and C, if they do lose their entire capital, they will embody the adage from President Trump that there can be, quote, no crying in the casino, end quote. And you know what? Okay, fine. I like this disclosure. I like it a lot.
Yeah. I think I think the filing should have a fucking skull and crossbones right on the cover. And you know what? Swim at your own risk. I really made a 180. First of all, I'm in the minority of people on Wall Street. I like Chamath. I don't care. I'm not embarrassed. The guy snake charmed me the first time I met him, and I'm still hypnotized by him. I don't invest with him. I'm not putting my money into his deals. His deals were mostly shit. The what is it, Hadassophilia or something? I don't even know what the hell
he was
that
in the
means.
arena. Don't be a baby.
Right. No, I don't give a shit. Like, he tried it. It didn't work. Now there are people that think he's like deliberately scamming people. Give me a break, dude. Don't you think he would have loved it more than anything if those stocks worked out and if those companies turned into great companies? He's just not that good at it, it turns out. That's okay. Most people aren't. So I'm not one of these like people that like knee jerk everything Chamath does. I have to talk shit about him. I like the guy. I think he's interesting. I don't want to invest with him. I don't like SPACs. I wrote a book where I did a whole chapter that SPACs are poison. I explained all the reasons why, all the fucked up incentives, and the carry, and all the reasons why it's like the deck is stacked against you. I went on everyone's clubhouse and I ranted and raved, and nobody listened, and everyone lost all their money. I did the best I could, but I don't hate the player. In that game, I hated the game. Anyway, I'm not buying Chamath's new SPAC either. I do think that this is a sign that we're getting closer to the end of something than the beginning. I do agree with that. And he probably would agree too, which is why you better sell this thing as fast as you can.
So, all right.
You might not have another chance to launch this in 6 months.
Another Canadian, Eric Jackson. Is he going to do this? Is this going to work?
This is like such a great heel turn from
tweet
Eric
on.
Jackson.
Tweet on. Is it all right? So,
What did he tweet? I can't see it. What did he tweet?
it says, when the pirates take over the ship and suddenly it starts sailing faster. So for those of you who don't know, and if you're watching the show, you do know, but Eric Jackson took Carvana. Eric Jackson was very early on Carvana, and he fucking 1000x'd it. I assume that he held for the majority of the time, maybe the whole time. Good for him. And so when he spoke,
Great call.
and when he spoke about the next 1000x, people listened, and I listened. I almost bought it. I didn't, and I regret not buying it, but whatever. So now they got the CEO out of her seat at Open Door. By all accounts, she was doing a terrible job. And Eric thinks this is the next 100-bagger, and he thinks it's going to $82 a share. And the question is, can Eric and the army of retail investors get this thing remotely close? It's at $3, where, I don't know, if it's $3-4, whatever it is. Can they do it?
The thing is that he started this at like 50 cents. So if you listen to him, you're already up a lot. And he's talking about this thing being worth thousands of percentage points more. He's from 82. But then he's like pulling a lot of the tricks out of like the classic playbook for this meme stock shit. Where he's like picking fights with people who disagreed with him, and he's doing like the memes.
He's all in on this.
He's all in on this.
Yeah.
And then he's also doing this thing where it's like this is like what's good for society. Like, thanks to Open Door, we're gonna solve the housing crisis. Like, I'm not so people accused him of manipulating. We didn't accuse him, we asked the question, is this manipulation? And I think if you play back what we said no, it's not. This is no different than anyone else saying they like a stock. The difference is it was a 50-cent stock, and he's not talking about it going from 50 cents to $5. He's talking about like going to almost 100. So it just like it gets under people's skin when you do that. But he's unapologetically doing it, and he doesn't believe that. I don't believe that the stock needs to go to 82 for him to be that for him to be right. If this goes to 10, This is one of the biggest winners anyone will have in their portfolio. And it definitely could go. There's a universe where this goes to 10.
Show the chart. Show the Eric Jackson effect. John, please. So this is the stock just getting destroyed. It's still down 90%. But show the next one.
Let's tell people what this. Wait. Go back to the other one real quick.
So actually, this is a Chamath stock, is it not? Wasn't this a Chamath SPAC?
It's a Chamath SPAC. So Open Door had this idea that they were going to digitally buy houses, like just on the internet, just bid for houses and then resell them.
By the way, there's an alternate universe. Chart off. There's an alternate universe where maybe it could have worked. I don't know, but they launched at the absolute worst time possible.
21.
Yeah.
Well, they went public at the worst time.
They launched into a housing mania.
Yeah. But I would also point out Zillow tried the same thing and it failed miserably also. It was horrible. It's not an easy thing to do.
It was the worst timing ever.
Yes. Now, the difference is Zillow got out of that business and Open Door is still at it.
And now they have a partnership, I think. But anyway.
Okay. But yes, this was one of the Chamath SPACs and it fell 99%. Like it is one of the most horrific pieces of paper to have occurred in that 21 to 25 period. And there were a lot of them. But this one was really bad. It's amazing it didn't go to zero, but it didn't. And now they seem to have gotten a handle on the losses at the company. Chamath is gone, and they fired the CEO, which, of course, you have to fire the CEO. The stock is 50 cents. But the average loss over the last 4 quarters is like $40 million. And they actually have been surprising to the upside, meaning the losses are smaller than expected. The company is claiming on an operating basis they're actually earning money. The problem is they have $2.2 billion in debt, so they're making a lot of interest payments on that debt, and they're barely profitable.
But they needed to get the CEO out. Hello, wake up, do an equity offering, raise some money, pay down the debt.
Well, so that's what I think is going to happen, and it should happen. And if you're long the stock and you truly are an investor, and you're not just trading it because it's a meme stock, you should want them to raise money. They should raise equity capital, and they should probably be talking about a reverse split. There is no institution that will own this stock at $3 a share. It should be $30 a share.
They don't want the institutional investors. $3 is the point. You know that.
You want the retail now, but you probably, as the story matures and the retail loses interest, then you're going to want institutions. So start thinking that way today.
Yeah.
Retail was still excited about GameStop when it went to 40. They didn't stop buying it.
Yeah.
So
show the chart about the year-to-date chart that we have. I mean, look what this guy did. It's
unbelievable. Eric did this, and he deserves credit because he probably brought this thing back from the dead. I don't know what would have happened absent him saying, "Hey guys, there's actually a valuable business here." So he did that.
Well, absent that, they would have ran out. They would have ran out of money.
You love them.
They would have ran out of money.
If you're short the stock, you hate them. If you're long the stock, you love them.
Yeah. Okay. Last topic. Cathie Wood. She's back.
I think she's back. What do you think? I want to hear what you think.
I don't think so.
What do you mean? Her ETFs are doing well.
They are.
Like, not just okay, they're doing really well.
Yeah.
And her stocks are working. We have a table of what she's buying or what her biggest positions are.
So it's Tesla, Roku, Coinbase, Tempest AI. Is that a private stock? I don't know that one. Roblox, Shopify, Palantir, CRISPR, Robinhood, and AMD. Listen, she's definitely back in the sense that the performance has turned around for sure. Balchunas tweeted, "Holy Noah, get it?" ARK is at the top of the 1 week flow leaderboard with $5.5 billion. It's a lot of money. It's more than VOO and the Qs. So she's not back.
She's back. This is her environment. This is her market. When the $3 stocks are going to $6, and when the money losing companies are up 40, 50, 60% off the April lows, and when everyone's talking about robots and AI and flying cars and gene editing and all that shit, this is her market.
Okay.
And that's what's going on. I'm not saying less forever.
No, listen, okay, fine. Looking backwards, absolutely she was back. Let's throw this chart of ARK versus S&P versus the Qs. So I'm guessing, so this is the last 3 years. And yeah, listen, I love that she made a comeback. I
Look
love
at
that
it.
I love more importantly, forget about her. The investors that stuck with her. I don't like to see people losing money ever. So
Right.
I very much am in favor, and I hope this continues, and I hope that investors get hold because it was a really, really difficult couple of years for them. So I'm rooting for them.
How about this? Here's another person. I don't invest with her, but I root for her and I like her personally. And it's another, like, there are a lot of people like that where it's like I don't really agree with the way you view markets, but like I like you and I root for you. I don't understand all the hatred. I guess like people were short stocks that she was long,
And
or
I understand some of it,
people get
more so for Chamath than for her, because Chamath was kind of a dick when people were chirping at him. Like he was not very nice to the people that lost a lot of money with him. Be a
so
little
I,
have a little bit of self introspection.
you know what? So I'm not on. I don't see it. I don't have the Twitter thing in front of me. But from what I hear, that's what he did. He like kicked the hornet's nest after these stocks blew up, and that never goes well. Remember all that stuff I was saying about how people use Joe Terranova's active ETF to like hit that segment of the market, the momentum trades.
Uh-huh.
Like what? Why not use ARC that way? Say to a client like, look, I don't buy shit like this.
Yeah.
I'm never gonna buy like gene editing stocks for you, and I'm not gonna be buying you Flutter and DraftKings and all that stuff. It's not what I do. But I recognize that in certain market environments, those stocks are going to outperform. So rather than me trying to do a Kathy Wood impression, I'm going to give you 3% ARC.
Yeah.
I'm going to give you 5% ARC. There's not, like, what's wrong with that?
No,
People
I
are
don't think
definitely doing
anything.
that.
Okay, so to their credit, ARC is outperforming the DGen Dow year to date. Chart on, please. So ARC is up 83% from the liberation lows, and this is a year to date chart. And yeah, it's so credit to
So
her.
we tried to come up with our own index of Kathy Wood-esque stocks, and she's beating them.
Okay.
So
All right.
we need to do an active rebalance.
Josh, I'm going to do a mystery chart real quick. I don't know if you could see it, but it's instructive just for the purposes of today's show. And then you'll make the case for Rocket. John, mystery chart on, please. Josh, can you see this chart?
Yes.
Okay. So this is
showing me the volume on the bottom pane.
Yeah. So I'm going to give it away because I don't know how else to give you a clue without giving it away. But I just think this is the sort of thing. Chart off for a second. This is the sort of thing where you talk a lot of shit. The internet gets up in arms, and then like it goes the other way and it never gets brought up again. So chart back on. What we're looking at here is a conversation that we had on the show, I guess 3 weeks ago, where I was defending the bankers. This is a new issue. Nobody is trying to misprice the shares, okay? They want to get it right for their clients. Their clients are the people that are paying them. And anyway, the stock popped, and now it's just gone nowhere but down ever since that first day. What is it?
Sigma?
Yes.
Yeah, you gave it
Sigma
away
boy.
because
Yeah.
I remember us talking about it. I don't think people are saying that the bankers deliberately
Oh, yes, they did.
screwed
Oh,
over
yeah.
the company
Yeah.
in favor of the shareholders. I
Yes,
don't
they
believe-
did. No, that is what
Who
people were
said
saying.
that?
That is what
I
that
don't say that. What
makes no
here's my-
sense.
My comment, well, no, it definitely makes no sense because I guarantee you the corporate issuer of securities who's going to sell stocks and bonds through you for the next 10 years is a way more profitable client
Thank you.
than the schmucks that are allocating 100 for that are asking for 100 shares of an IPO. 100% I agree. My comment is, how is it possible we're doing this shit since Amsterdam in the 1600s? How can we be so bad at gauging the demand for a stock after 525 years of initial public offerings on exchanges around the world, from Europe to New York to San
I'll tell you
Francisco
why.
to
I'll
Asia?
tell you why.
Why is this like?
I'll tell you.
Dude, Mike, they're getting it wrong by a factor of 100%. What the fuck kind of business is
Let me
this?
quote our friends. Then we quote our friend Phil Perlman. I believe this is the tweet. Here's the thing about behavioral finance. People are crazy. Was that the tweet? Do you remember that tweet?
Yes,
You can't price mob behavior.
I reject that.
Dude,
I
they
reject- there's
can't
gotta be
do
a
it.
better
They
way.
can't do
There's
it.
got to be a better. There's got to be a better way. I think somebody
Oh
benefits
yeah, genius.
from
Who?
the way it is.
How?
I don't know.
But there's
I'm just
got to be a
asking the
better way.
questions. There has to be. I'm not suggesting that I'll come up with it. You're telling me that
Yes.
somebody is not benefiting from this circus? It's just this random thing that we can't get better at.
Sometimes
500 years of
they price
pricing
it high, and
IPOs.
sometimes they price it low.
The average IPO should not open up 100% higher than the pricing.
It doesn't. The average does not. The average does
It's
not.
literally what's going on all summer. We just talked about Bullish. We did Circle. We did Figma. We did
Okay,
CoreWeave.
Figma
How
went to
many more examples
150
do
and
you
now
need?
it's 60. By the way, it's 69.69 in the after hours. Very, very nice. It's
Double
not
nice.
the banker's fault that people go nuts when these shares start trading and then they lose interest. How is that a banker problem? People get excited and then they get bored.
So there's the way the auctioning is working.
All right,
If they
whatever.
really
Make the
wanted to
case-
get it
make the
closer
case-
to reality.
Make the case for Rocket.
We're not really making the case because we've already done that on the show. We are giving people an update because today there was a very big initiation of coverage on Rocket, and we have people, that have listened to us make the case on the stock before. Double disclosure here: not only do we own the stock personally, but Rocket has a subsidiary called Rocket Money, which is a frequent advertiser on the compound.
Double. Classic
it's a
double disclosure.
Double disclosure, but we're very transparent here. Anyway, the stock is working. The stock is up huge from its lows on the year. It is, I think, up in anticipation of rate cuts. When they closed this acquisition of Mr. Cooper, according to the analyst at BTIG, who initiated coverage with a $25 price target today, Rocket will become the largest originator and servicer of mortgages in the United States. Most of the shares outstanding are not in the float, meaning like there's a lot of shares that are non-traded, and so it looks like it's got a tiny market cap, but like the real value of this company is like in the 30-ish billions range. But if rates come down over the next year or 2 years, and we have another cycle in housing, and we see a lot of transactions in an existing market, and we see refi activity, and we see the young millennials and older Gen Zs start to really participate in the housing market, these guys will have the best mousetrap technologically to grab all that business. Not only did they make this Mr. Cooper acquisition, which is the largest independent portfolio of mortgage servicing, they also bought Redfin, which is a leading lead gen app for realtors and mortgage brokers. So they have built this, like during this time of depressed activity in housing, they have built this vertical empire. And that's what the analyst wrote about today. You heard it here first from us at 11, $12 a share. Now it's 18. The analyst says in the bull case, with both rate cuts and $500 million worth of merger synergy, this could really be a $30 stock. So reason to hang on. And if you can get yourself a copy of that BTIG note and you're long the stock, I highly recommend reading it. It was really well done. All right, that's it from me. Michael, you did an amazing job. I apologize for my technological issues.
Happens.
We didn't miss a beat, and you were there to save us. Guys, thank you so much for listening. Thanks for watching. Special thanks to our friend Neil Dutta for stopping by and filling us in on the Jackson Hole outlook. Tomorrow is an all-new edition of Animal Spirits. First thing in the morning, we'll do another Ask the Compound this week. And then at the end of the week, it's a very special Compound and Friends with a returning champion, someone whom I know you're all dying to hear from and see. So you're not going to want to miss that either. Thanks again. Have a great night. We'll talk to you soon.